Welcome to Exhibiting Our Investment Artists webinar by Curate Investments. My name is Udirile Sibolao, and it is my pleasure to be hosting you today. We have an exciting agenda, but before we delve into the session, let me first address a few housekeeping matters. We have applied for Continuous Professional Development, or CPD points, to make sure your attendance is verified. Kindly watch the entire session and provide your ID number in the CPD section. Our event platform will be open until the end of December 2025 for you to still watch it and get your CPD points. Our event platform automatically emails you your CPD certificate as soon as you have watched the full session. In terms of the agenda, during this webinar, we will explore the theme, The Global Edge, the case for global equity diversification. Equities, as you know, are a critical component of achieving your client's financial future, and in this session, we will place the spotlight on two of our hand-picked equity investment managers, Laurium Capital from South Africa and Robeco from the Netherlands. Also, given that Curate selects investment talent from far and wide, our head of proposition, Ali Simpkins, will demonstrate how we do so, why we do so, and how it benefits you and your clients. As the program unfolds, please feel free to ask any questions in the Q&A section, and our speakers will address them in real time or respond after the session. First, you will hear from Laurium Capital, fund manager of the Curate Momentum Equity Fund, who will tell us more about how they are electrifying equity.
Thank you, Adelida. Good day, everybody. I'm Junaid Braham, one of the portfolio managers at Laurium Capital, and we are proud to be partners with Curate, and we manage the Curate Momentum Equity Fund. So the theme of today's presentation, we're just going to take you through some of the ideas of where we're seeing opportunity in the market, and particularly with the theme of electrification, and how we've positioned the fund to benefit from some of those ideas and that theme going forward. So to give you a brief overview and highlight of the fund, the Curate Momentum Equity Fund, it's predominantly a South African equity fund, but it does include some global ideas, and really it's complemented by some of our best ideas and high conviction global ideas. And what that also does is it diversifies the portfolio, so it allows us to invest in some of the sectors and themes that we don't ordinarily get direct access to on the JSE. The likes of pharma, tech, etc. And it just really allows us to implement some of those ideas in the fund. So if I look at just a brief background on Laurium Capital and who we are, we've been around for about 17 years, started in 2008, initially as a hedge fund, and we've diversified the business, adding our skill set and track records across South African non-only funds, an African equity capability as well as a global equity capability. And I think what makes us a bit unique is that we've got one integrated research and investment team across all these different funds. And we even though we've grown to about 75 billion rand of assets under management, we place a high emphasis on always staying with the boutique mindset and entrepreneurial mindset that made us successful at the beginning, and we still keep that the boutique agility in the style that we manage the firm as well as we manage the funds, and the firm is owner managed, so we don't have any external shareholders. The shareholders are all, other than a trust, or the ownership of the firm is all owned by staff. So if I look at the key portfolio managers on this fund, so the two co-founders of the firm, Mari Winkler and Gavin Forberg, who started the firm back in 2008, around the time of the global financial crisis. The other portfolio managers are myself and Mike Lawrenson, and then Rob Ullerman, who's our global portfolio manager. We work very closely with Rob to get the best of his global ideas into the fund. And we're supported by a team of about 15 investment professionals, analysts, as well as our traders and quants guys. Looking at the performance of the fund, so the fund doesn't have that long a track record, but I think year to date, the fund is doing reasonably well. We're up about just under 25% year to date. And if we think about our benchmark, the way we think about it, the fund is roughly 2/3 South African equity, 1/3 global equity. And the blend of the Capswix and ACWI in those proportions is up about 22.7%. So we're just shy of about 2% of alpha year to date. And then against the peer group, which is South African equity funds with an offshore component, we're well ahead of the peer group as well year to date. And you can see that the local market has actually been very strong. The local market's done about 31%. And in Rand terms, the MSCI All Country World Index is up about 8.2%. So if I look at where that performance has come from, we've had a reasonable exposure to gold and platinum, and some of those names, predominantly our exposure to Anglo Gold, which have been our preferred pick. That's contributed very nicely to performance, as well as Impala and Northam. And then Naspers and Prosus, also a high conviction name in the fund. That's contributed to performance. And then some of our offshore names, the likes of Quanta, Broadcom, GE Vernova, and Arca Continental, as well as JP Morgan Chase, all contributing positively. What's detracted from performance, really a lot of the gold and platinum names, which have also been very strong, which we haven't had exposure to, detracted to performance on a relative basis. And I'll touch a bit more on some of those names going forward. So if we just look at the SA equity market, that 31% that we've had this year to date to the end of September, it's been very strong. But it has been a very narrow market. If we look at where that performance has come from, so what we're looking at on the slide is really the contributors to the 31%. So you can see gold up until the end of September has contributed about 14% of that 31%. PGM's another 6%. So nearly 20%, over 20% of the 31 comes from gold and platinum. And then Naspers and Prosus another 6%. And then the telco space has actually been very strong this year, another 2.5%. And then there's a tails off quite quickly after that. But you can see how narrow the performance of the market has been. So gold's been strong, and we know, of course, the gold price has been, we all know the gold price has been very strong, crossing 4,000 and pulling back from the, and then PGM prices as well. That's platinum group metals, mainly platinum, palladium, and rhodium, and then a tail of smaller metals, also being very strong. So what's driven that? I mean, we know that, in the heightened geopolitical uncertain environment of 24 months, that's given some tailwinds to the gold price. And I think a big change in the market was, so if we look at what's driven the gold price, and I think a key game changer to the backdrop of what's driven the gold price, I think after Russia invaded Ukraine, and I think, reserves were sort of weaponized, central banks, especially emerging market central banks, started diversifying away from the dollar and started adding gold. So you can see that this is the net quantity of purchases by global central banks. You can see that in the last 3 years, how that spiked and how high that is relative to history. And it has pulled back a bit this year, given the much higher gold price that we have at the moment. But it's still relatively elevated, and we don't expect that to change. So what we're seeing is really just that central banks diversifying away from the gold price. And if you look at the next slide, just really shows you the percentage of holdings that foreign central banks hold in gold. You can see that's been increasing, while the percent held in dollars has been decreasing as central banks diversify away. Then another leg that's been driving it, of course, investment flows. Now there's a mix between retail investors as well as institutional investors. That's also been picking up. From an institutional side, you found that normal 60-40 equity bond portfolios haven't really been working. The bond component hasn't been, offsetting as historically you get the negative correlation, hasn't been working that well. And of course, the concerns about foreign debt levels. So institutional investors have been increasing their holdings in gold, as well as retail investors. So that last leg is also, in the last 2-3 years, you can see that the The holdings from ETFs have picked up, and that's reflective of investment inflows. So that's also gone, taken the gold price higher. So what does this all mean for South Africa? So we obviously know that, now nearly a quarter of our SA equity market is made up of gold and precious metals companies, platinum companies. But beyond the market, from an economic impact perspective, if the prices stay high, and what I'm really showing you here is the terms of trade. So when the terms of trade move positively, I think it does create, there's a possible uh, positive benefit from economic perspective, both from a GDP addition perspective, when you're looking at your exports less imports. So if I just look at a proxy for the gold and platinum less oil, because gold and platinum are nearly 20% of our exports still, despite South Africa reducing much less gold than we did decades ago. It's still combined about nearly 20%. And then oil is one of our biggest, oil and oil related products, one of our biggest imports, and oil prices have been low. So the net result is a very positive proxy for where our terms of trade are headed. So obviously you get the terms of trade data with a lag. You can see that the prices stay where they are. That should move quite positively going forward. And that's got multiple ripple effects for the economy. You get the mining companies earning higher earnings. So that means higher royalties and tax receipts. They also tend to pay some extra bonuses to the employees. So around mining towns, those employees, the spend does tend to pick up. And we have seen that correlation historically. Of course, there's the lag of normally 9 months plus. So we're still relatively early into this, and we haven't really seen that benefit come through yet. But we do expect that to start coming through in the next couple of months, next probably 12 months or so. So overall, the backdrop that creates for South African equities, I think you've got improving terms of trade and helping to support consumer spending. We've also got lower interest rates. We're still expecting possibly another 1 or 2 rate cuts coming through, and inflation's been low. So that's supportive of real disposable incomes. So we expect some of that to come through. Then we've the GNU, we know that, it's not been without its wobbles and issues, but overall we are seeing reforms move in the right direction. Granted, it hasn't been as strong as we would have liked it to have been, or as quick as we would have liked to have been. But we are seeing, for example, we're not really talking about load shedding anymore. I think that's been largely resolved. The next leg is logistics, and we're seeing a lot of bids being put out for private sector participation in the rail networks, both from a passenger perspective as well as from logistics for goods at the ports as well. So I think that's going to take a while to come through, but I think in the next 3 to 5 years, as you get the construction spend for that, and eventually the benefits of improved rail networks, I think that's usually positive for our economy off a very low base. And then I think overall the trend of the dollar weakening. Look, we're not out here to call currencies, but it does seem that that the dollar could continue to weaken, and that's normally supportive for emerging markets like ourselves. We get higher commodity prices, as well as diversification away from dollar assets. So we're well placed to benefit from that, especially given where our valuations are. They're very cheap. So if we look at what's happened more recently in our local market, we've seen that our bond yields have actually strengthened quite a lot now. We know that the new Reserve Bank target of about 3% inflation, that's been very well taken by and received by the market. So we've seen our bond yields rally, and in fact, it's gone close to 9%. And that's sort of the risk-free rate in our market, our 10-year bond yield. But this time around, normally we see a correlation with equities. This time around, we actually haven't seen that. Our equities, if we look at what we're looking at here, we've got custom domestic SA index. So what we do is, what I'm looking at on the blue line is the domestic SA index. So we take out all the mining companies, the foreign dual listed companies, and we're focusing really just on the local focused companies. So mostly banks, retailers, insurers, and industrials. And you can see that relative to history, they're trading quite cheap. And they tend to price off the bond yield generally because that's your risk-free rate in your cost of equity. And this time around, we haven't seen that follow through. So our equities are still cheap. even our bonds have strengthened quite a lot. And we think that's quite a dislocation. One of it needs to move the other way, and we think it's likely that equities need to move higher. And then, of course, we know that if we look at our domestic SA market versus the global emerging markets as well as developed markets and the MSCI world, we are trading cheap, and we still trade at quite a discount to our peer markets. So just looking at the theme of electrification, we've obviously heard about the hype around, AI, etc. So important to point out, we're not making a call on whether the AI, all the capex that we're seeing being spent or announced will translate into real benefits down the line, as well as whether we are in an AI bubble or not. We have seen the AI capex numbers pick up from all the major companies, and the slide I'm showing you really is just all the major companies, the hyperscalers, Amazon, Microsoft, Google, Meta, Oracle as proxies, how in the last couple of years and the projections for the next 3 to 5 years, they're spending multiples of what they spent historically. So cumulatively, they'll be spending nearly $500 billion per annum on capex. And again, we're not pointing out whether there'll be real benefits or not, but that capex will be spent. And where a big chunk of where the capex goes is actually into AI and data centers. Now, AI-related data centers are highly energy intensive. The chips that get used in those data centers and servers are highly energy intensive, and they could use up to 4 times what a normal AI server takes in terms of power consumption. And the demand from data centers is expected to double in the US in the next couple of years, given all this capex that we're seeing. And that takes the overall data center consumption as a percent of total US consumption from about 2.5% to 7.5% in the next few years. Now you're adding all this demand onto an already constrained grid, and the US grid is extremely constrained, not only in the US, around the world. When most of the grid is aged, and you're adding a lot of more power demands onto that grid, and the net result is you need to spend on the grid, and you also need to spend on this AI data centers. Now we've got several companies that we've invested in that benefits from the electrification part of the global theme of the capex spend, and those are Quanta, which is an electrical contractor, and they've got high market shares in transmission as well as build out of electrical contracting in the US, and they stand to benefit quite strongly as the larger players tend to partner with the larger contractors. They've got high market shares, and they've done well. And then GE Vernova is another company. They spun out of GE, and they do sort of the gas turbines and power generation is what they do. So they've got their backlogs on both of these companies have grown very strongly. And we continue to benefit. We held these names in our fund, and they've done well for us, and we continue to see a good outlook for them. Then the other part of the equation with the spend, I think you've gone through, is at the end of the day, copper demand, because you need huge amounts of copper. So the copper is the one metal that we're very bullish on going forward. So if I just look at North American copper demand, going back historically, you've had a period of where production was an deindustrialization in the US, where things were outsourced to the East, to China. That we went through a few decades of that, and then a couple of decades where demand was fairly stable, as that had stabilized. But I think where we are now, you've got the AI demand on the one hand, and then you've also got reshoring. So we know a lot of this, the reshoring may not happen, but there is a big chunk of reshoring that will take place with global corporations re-establishing production capabilities in the US, and that's expected to increase copper demand. And there we've got exposure via Anglo American and Glencore. Now, Anglo American, with the recently announced tech deal, will increase their copper exposure to about 70%, and that's high quality copper. They've spent the capex, and that production is coming online. And then Glencore is about 40% exposure to copper. So domestically, that's how we playing some of that theme, where we think copper is from a supply and demand perspective well positioned. So overall, from an electrifying equity theme in our portfolio, these are some of the names that we've got. I mentioned Quanta, GE Vernova, Broadcom is really on the chip side. Siemens, the global, the German industrial conglomerate, also expected to benefit in Europe. And then from a copper demand perspective, Anglo American and Glencore. Those are the names and some how we position the portfolio to benefit from some of the theme of electrification. So just looking at the fund positioning, the fund is well diversified, and we're very bullish on financials, particularly SA banks, some of the SA insurers, and then some of the global banks as well. We've complemented some of those names in there. That's nearly a quarter of the portfolio. And then materials, another quarter of the portfolio, and that's largely diversified miners, gold and platinum companies. And then consumer discretionary, another 20%. And then some staple exposure, which we think the staples that have derated quite a lot, with the exception of tobacco. And those are, from a long-term perspective, offering a lot of value at current levels. And we've been adding to some of those names, particularly in the beverage space. So from a SA stock perspective, then the way we break up the themes or the buckets in our domestic market, we've got our global non-resource rand hedges. So we're still very bullish on Naspers and Prosus, and that's largely we still think Tencent is a high quality company that will benefit from AI in China, and they've got a 1.4 billion user base within WeChat, and that's their messaging super app. We think that outside of Tencent, the RUMP assets outside of Tencent, predominantly food retailing and classifieds, have turned free cash flow positive, and we expect that the discount will narrow and the market will start assigning value on those assets in the next few years. So we expect further narrowing of the discount. AB InBev, we think that there are headwinds to global beverage consumption, but we think that the free cash flow generation is very high, and the company is de-gearing with that cash generation. So the outlook still looks good, and valuation is attractive. And then those are some of the other names. Then I think where we're really excited domestically is really on the SA Inc. side, and we've got exposure there via the financials as well as some of the consumer and industrial names. So particularly on the financial side, the banks, we think they're exceptionally attractive from a valuation perspective, and you underpinned by very high dividend yields. So you get paid while you wait, with dividend yields of about 6 to nearly 10% on some of the names. And then on the insurer side, Momentum, we've done very well. We continue to hold on to our Momentum position. And then domestically, some of the retailers and consumer discretionary names and industrial companies. And then from the resource perspective, I've spoken about Anglo American and Glencore. We've also, our preferred names in gold is Anglo Gold, and then Impala Platinum on the PGM side. Some of the names that we've complemented the portfolio from a global high conviction positions. From a technology perspective, we've gotten with the names that we feel we've got more conviction on a long-term earnings delivery perspective, as well as where we feel the valuations are not excessive. And those are Microsoft, Broadcom, and Meta. From a consumer side, we've got exposure to Arca Continental, which is a Mexican and American Coke bottler. So we don't have direct exposure to Coke bottlers or soft beverages in South Africa. So that complements the portfolio. And then EssilorLuxottica, the sunglass manufacturer, the owner of Ray-Bans, they've partnered recently with Meta and smart glasses, etc. That's going to be quite a big driver going forward. And then from a pharma perspective, we don't have direct pharma other than a generic pharma locally. So we've complemented the portfolio with the likes of AstraZeneca. They've got a good oncology portfolio. Eli Lilly from a GLP-1 perspective, and then United Healthcare from healthcare in the US. And then I mentioned the likes of GE, Vernova, and Quanta, again, part of the electrification theme that we see going forward. And Shell from an oil perspective, as well as Siemens, which also benefits from electrification in Europe. And that's overall how we position the portfolio and some of the opportunities that we're excited about, and we're looking forward to continue adding alpha for our clients. Thank you.
Thank you, Junaid. The Curate Momentum Equity Fund is a unique mandate that strengthens diversification by allocating across local and global shares, giving investors a broad access to opportunity set and participating in markets unavailable to pure local equity investors. As you heard from Junaid, Laurium are certainly tuned into what is happening within the South African context, but this Curate mandate allows them to also bring in ideas and key growth themes into the portfolio, like global electrification and the massive demand there is for power generation globally, given AI enhancements. Next is Leda Bajo, the Deputy Head of Quants and Client Portfolio Manager at Robeco Asset Management. Leda will delve into enhanced indexing equities. As one of Europe's leading investment managers, Robeco specializes in applying cutting-edge research and data-driven signals to construct portfolios designed to enhance client returns. The fund manager will share how the team harnesses vast amounts of data and quantitative insights to uncover opportunities, improve consistency, and deliver long-term value for investors.
Good day, everybody. It's a pleasure that you could all make it to the Enhanced Indexing Equities Delivering Long-Term Value session of Robeco today, together with Curate. It is a pleasure to have you all in this call. And I'll start more in general. I'll start with our expected returns today, like what has been changed or has been developed throughout in the last months. As you probably know, we have a study publishing that comes every year, and that's the forecast for the next 5 years. The paradox of innovation, meeting chaos, can be seen in artificial intelligence driving humanity, economic and social progress. While on the other side, we also see lots of global policy uncertainty that remains quite elevating, receiving more, let's say, what's going on in the US as the largest economy. That's all, and if I see what's the expectation from 2026 to 2030, we do see that this time emerging markets are seen as the asset class that will deliver the highest return, actually 7.5% a year in Europe from 2026 to 2023. Developed markets are returning 6%, which is not far behind the emerging markets of 7.5%, but nevertheless they are a bit less than that. On the other side, we also see local government debt and listed real estate at 5.5%. And unlike previous years, what you do see this time is that corporate bonds are not seen returning much more than government bonds, with returns of 3.25%. So hence, it's quite exciting. We do have good valuation in both developed and emerging markets, but also other asset classes. Looking further, over the past 12 months, we actually have seen many macroeconomic and geopolitical developments and events happening, and that have had, of course, substantial effects also in the different asset classes, and especially the equities in this session has been looking at. How have global financial markets have been able to weather the storm of these full bonding narratives? So what we do see is that equity markets valuation, looking at it in a longer perspective, they have remained above average, and they've probably a good reason for that has been also the interest rates. So, which from 2022, both nominal and real interest rates have increased, so that basically that argument of interest rates for such strong valuations is not that strong anymore. It's how it used to be. But another way of putting, let's say, this absolute valuation to perspective is to see the equity premium risk. And that's what you see in this slide. Equity premium risks that are priced in by the market. At around 0.3%, we see that the implied equity premium of the US is currently relatively low, especially when you compare that to the Europe one, which is quite nice, 4.3%, I would say. And the current implied US premiums show that investors are only slightly, the equity investors are only slightly above the bond investors. So high interest rates and an expensive stocks market can lead to positive, but also very low expected excess return for equity investors. You also do see there emerging markets. So the implied equity premium for emerging markets, it's quite elevated, 6.2%, above that of the European, suggesting that emerging market equities are relatively attractively valued at the moment. We also saw that previously in the previous slide, and the valuation of emerging markets have been consistently below those of the developed markets, so trading at a discount like of 20 to 30%. And if you look at it on a long-term perspective, we do see also from this chart that those developed and emerging markets remain to be quite attractive, and valuations do matter for these long-term outcomes when you look into that. So hence, probably it's a safer bet to go enhanced indexing. Enhanced indexing is designed with the aim to efficiently capture returns while aiming to minimize the risk. So what's our goal? When you call enhanced indexing, you can call it passive plus, different. Yeah, it's mentioned differently within the market. So we do want to capture that growth market exposure and high liquidity. We want to have a high liquidity portfolio, especially at such times. You do receive that with passive investing. You do get that with our Robeco enhanced indexing strategy. And you also get it with, would you get it with Active Plus? So that's the question. Not sure, because it depends a lot on how the market's going. You actually then in that case, we take higher bets. So yeah, it's a question mark. We have a constraint, country allocation deviations from benchmark, crucial, especially in emerging markets, I would say. You do get that probably with passive investor, smaller deviations. Definitely you get it with Robeco enhanced indexing, country neutral in emerging markets. Active, I don't think so. Concentrated sector allocation deviations, same applies to passive investing as previously and our enhanced indexing. Predictable risk return characteristics, definitely you'd get that as well with our enhanced indexing approach. Would you get it as active at all times? Not sure, because the bets, if it's more than 3% of a tracking error, it's not there. But it's also predictable in the passive investing side, of course, with the higher fees. Because at the end of the day, what counts is the net performance. We do that with a proprietary stock selection model. We don't blindly only follow the markets like what passive investors do, what the markets is already, because they proportionally buy everything. While you have smart team in place that proportionally selects the best or over and underweights the best stocks in there. So our proprietary stock selection model. Active managers have selection models in place as well. We do have smart rebalancing, efficient trading in place, crucial. That distinguishes us from both the left and the right-hand side, so basically from lower and higher tracking error. It is a very highly diversified portfolio. Not taking everything in passive. I don't call that like really completely passive. On the right-hand side, on the more active portfolio, then you would have, depends on the number of stocks, because there you can also go active on different levels. And we definitely, what you do get in here as well is sustainability. You do get an enhanced sustainability profile. You don't get that if you buy the market. And it's a question when it comes to your active plus investing that needs to be seen with the manager that you choose. But how do we do that all? What does enhanced indexing mean for us? How do we choose these great stocks to over and underweight? We use our own proprietary stock selection model. We want to find the super stock, the stocks that deliver the nicest performance, that can deliver long-term performance. And that super stock has different characteristics: value, quality, momentum, analyst revision, or short-term signals, if I group it in big factors. What's a value stock? It's a stock the trades in attractive valuation. Stocks with attractive valuations tend to outperform those with less attractive valuation. And here we also look on a number of diversified valuation factors, such as, for instance, price to fundamentals. You try to definitely harvest the value premium efficiently. So basically avoiding as well different value traps. But you also want to have good quality stocks. When it comes to stocks, quality stocks, we definitely look at stocks with good and sound fundamentals that tend to outperform those with weak fundamentals. And of course, the market as a whole. In this case, we adopt a multidimensional view of quality that incorporates profitability, earnings, or investments. It is a multidimensional view, and this way it's more a forward-looking signals compared to the generic market definitions. But of course, profitability profile is also, as mentioned, one important element of our quality basket. Price momentum, stocks with positive momentum, which we define as stocks with highest recent stock returns, tend to outperform those with a negative momentum. But we also, in addition to that, we use advanced residualization techniques so that stock-specific returns are adjusted for other characteristics. Analyst revisions. I like to tell that that's probably the more educated momentum in another way. So we look at recent upwards analyst revisions that tend to outperform those that companies that have received downward revisions. So analysts have become more positive about company earnings. So this way, these factors captures the best way possible on multiple analyst revision. And also here we use residualization technique because it's very important to actually address the biases. As we know, the analysts also have their biases. And last but not least, I would probably go to the short-term signals. The short-term signals, which we consider stocks with the short-term dynamic to create a final stock ranking of the most attractive stocks. Here, we would look at stocks that tend to outperform those with the negative short dynamics. We incorporate signals that aim to exploit stocks' price reversal, short-term sentiments, let's say short-term stock, industry, or factor momentum that could be looked at it, short-term flows, or other short-term return patterns. And on that topic, so we do see that we've developed a lot with time, and our model, so finding the super stock, it's at all times market proof. So it's never evolution, always an evolution, and making sure that we've got the best model in place to tackle the markets. And it's not always easy, and it's been changing, and it's challenging for us as well, and we like it. What we do see, you probably hear also a lot about next generation quant, a lot going on, AI, and so on and so forth. Yeah, as time progresses, technology also develops, and so do our strategies. And there are three transformative forces, I would say, that are shaping our investment domain over the last years. One of them is data. Every second, every minute that passes, zillions of data is produced. My watch, for instance, is recording my heartbeat every second. Probably our conversation now is being recorded. Megabytes of data are being produced every minute by our cell phones, even when that's not in use. So lots of data has been generated. So this is like one of the biggest trends that we see. So this transformative forces. Like if you only see the ChatGPT, the what we do in Facebook, Amazon, and so on and so forth, it's a lot of data. But this data is useless unless, of course, it has an impact, like for investments. Because it's my heartbeat. like my watch, I mean, it's not relevant about investments, how like my heartbeat would be. But of course, you need to also be selective. And hence, it is very good to also have enough computing power to actually analyze that. Therefore, a second transformative trend is the computing power. Obviously, the data is only useful if you can compute with it. So there are examples of different algorithms that run, like for instance, for different reasons. Like we see, there are the ones for gaming or speech recognition, vision, languages, and so on and so forth. The complexity of this exponential order, which is very fast growth, then you can see, especially on the y-axis, then you see how fast has been growing. So if you think of ChatGPT or GPT-3, was the most innovative thing 3 years ago. But now, GPT-4, much more parameter than the predecessor had. If you see the exponential of those last, especially on those last year, you see that the data and the computing power has been developing really at very fast pace. And that brings me to the algorithms that we need to use in order to make the best use of the data we have in place and also the computing power. The algorithms are also growing. AI was established circa 50 years ago. And basically every decision-making algorithm that is trying to behave a lot like a human, they'd call it AI, so that's a broader sphere. But AI later on evolved as well to, say, ML, so machine learning. It is the decision-making process that can adapt to the new data that comes. So machine learning is when this algorithm adapts with new observation that is fed into the model. Then, as you see, it goes further, and then you see the natural language processing. This is going to be huge. It's a huge area. We have been talking about it in the last, but definitely the future for the next year to come is also there present. In finance, we use numbers, right? We harvest numbers from the financial reports, and then we do our magic with the numbers. But with NLP, we can go to the text and extract actually value from the text. Deep learning, it's basically the algorithm that we're training for training these machines, and then you go to large language models, which is extract data from text and replicate, also booming. So these are the three trends. We are, remember, our models should be market-proof, and hence that's also what we do, and we develop with time. And I'll share with you a couple of examples on how we've incorporated more novel signals with time. Employee ratings and reviews to shed light on productivity levels. So applying these NLP techniques to uncover alternative alpha sources is also key. They say culture does eat strategy for breakfast, and probably that's also the case. Hence, it is important. Another way of looking at it, of looking at human capital as the most important tangible asset for a company, especially a company like ours. A satisfied workforce is expected definitely to be more motivated and efficient. Hence, employee engagement is an important driver of productivity. We base this basically on the employee reviews and rating. So we expect this to be translated in future higher returns. So, the satisfied workforce is also desirable from the perspective of corporate social responsibility. And this evidence shows that engaged employees, that's the blue bar that you see, are more productive as measured by sales over payroll expenses. And this signal does add additional alpha on top of our existing model and enhances our quality factor, being implemented in our model officially in basically since 2023. I want to give one more example, and that's on machine learning. Machine learning can detect interactions when market overreacts or recovers. So there's news. So linking these short-term reversals with inherent value. So what's the rationale? Economic rationale is key. So news and liquidity affect stocks' intrinsic value. So for instance, reversal strategies buy short-term losers and sell short-term winners. And also we look at the strength of revisions upon the amount of news and the trading volume. So short-term reversal is a fundamental signal in our, remember the short-term timing model? So the fifth one that I explained previously. So reversal strategies buy stocks that have recently gone down and sell stocks that recently have gone up, attempting basically to profit from this expected reversion in price. While the reversion is typically driven by investors' over and reaction to this news that come, and data talked about it, that has been increasing a lot. And therefore, this is a naive way of looking at it. If the price of a stock fails due to a news, it keeps falling further and further. It is therefore important to just not consider one dimension, but to consider other dimensions of it as well. We use machine learning framework for the interaction between short-term price moves, news, and trading volume. And this all can be modeled. So evidence here also shows that there is a lot of news, trading, short-term price movements that tend to be stickier and more persistent. And thus there is less reversal for the stocks. For instance, stocks that have recently gone down, so the short-term losers, and a lot of news volume tend to reverse in price less than short-term losers that have recently gone down on less news. So the same evidence also holds for the other sides of short-term winners as well. So yeah, this is also another additional alpha signals that add on top to our model and enhances another factor from 5, our short-term timing signals. And an example, fresh example on the emerging market strategy in this year's are the China-only signals. Adding China signals to emerging market strategy. With the big data, you are able to do that. Basically, extending proven China A signals to emerging market strategy, hence indexing, in your case. And we've been adding the China signals to improve the performance of the strategy. What do we do in that case? We look at changes in number of posts about a certain stocks, measured retail attention. So basically changing in number of posts about certain stocks. We will be looking at, because as we know, with the big data, there's information that could be extracted in China that cannot be definitely extracted in other regions. So hence, we do incorporate that as well, because Chinese companies, visitors and visits, the companies in Shenzhen Stock Exchange are obliged to actually disclose investor and analyst visits. An idea is that more institutional attention predicts future outperformance. And this way would, for instance, be looking at the number of visits or visitors a company gets. So you could go get information out of this information that they are obliged to make public. These are just 3 examples of how we actually do incorporate that all as we've developed our models with time. A very important part, beside the stock selection, is, of course, how we construct the portfolios. The Curate Global and the Curate Global Emerging Market equity funds are systematic approaches. One is in the MSCI World, the Curate Global Sustainable Equity Fund, and the Global Emerging Market Equity Fund is on the emerging market index. We do extend the number of stocks in our universe by adding large liquid off-benchmark stocks. That all comes in a ranking where we rank such stocks with academically proven characteristics and novel characteristics, what I've been talking so far, so basically our model and signals that we'll be developing with time. And what we do, we do small over and underweights of individual positions. minus 45 basis points up to 30 basis points in the Global Sustainable Equity Fund, and 30 basis points minus up to 20 basis points up on the Emerging Market Fund. We have small deviations on country and sectors, and same applies to both strategies. Country neutrality mentioned previously too. It is key when it comes to the emerging market funds. I did mention that we extend our universe with the off benchmark, but they also have a limit because we also have a tracking error limit, and we also we work on our on how we measure our risk, how we do our risk management. That's why only 5% max of benchmark positions to both of them. We do have a superior sustainability profile for both strategies, but we even go more in depth when it comes to the Global Sustainable Equity Fund. And that means not just better than the index, but at least 10% better when it comes to the ESG risk rating, carbon footprint, 30% better than the index, water usage and waste generation, 20% better or lower in that case than the index. And we do exclude SDGs -3 and -2 because the SDG rating would be from -3 to +3, and -3 and -2 being the one that have the most negative effect on there. And that brings us to actually the final portfolio. Our goal is to have optimized an information ratio, to have the best expected information ratio out there, and that's 0.65 expectation, long-term expectation for the Global Sustainable Equity Fund, and 1 for the Emerging Markets Equity Fund. We've overdone it, and we're very happy with it. That we'll leave the cherry for the end, the cherry on the cake for the end, and then that has been managed with an ex-ante tracking error on the Global Sustainable Fund of 1.5% long-term ex-ante expected tracking error, and 1.2% on the Emerging Market Fund. Bring us to an expected long-term outperform 1% or 1.2% on the emerging market, and really very broadly diversified. As you see already, the number of stocks that we expect to have, it's not like we have a certain number of stocks. Now the goal is the result of all the portfolio construction. It's not passive, so we don't have all the 1,300 stocks of the MSCI World or all the stocks that are in MSCI Emerging Markets, but it doesn't also have 2 digits number of stocks, if you come back to those first slides, to that an active manager would have. We have on the ±400 stocks on a monthly basis, on the Sustainable Equity Fund, and on the Emerging Market Fund, roughly 500 stocks. And this gives us if I go back to I might remind you again of the title of today's presentation, enhanced indexing, delivering long-term value by being broadly as well diversified. So what's the best proof of any strategy that we've been working on for a long time of the team than the track record? And the track record do speak for themselves as well. We've started with the Curate Global Sustainable Equity Fund in May 2020. And it hasn't always been a smooth ride, but it's been a nice ride. We could deliver very nice outperformance, relative outperformance, and on an absolute basis, also quite nice. And if I concentrate on more on the year-to-date or 12 months perspective, we could deliver this year outperformance versus the index on a 1-year perspective that actually 2% ahead. Also from a long-term perspective, actually very nice result. At least the same I would be able to say on the emerging markets investment, the Curate Global Emerging Market Equity Fund. We started that on March 2020. And we've had a very nice run, also very nice result, but especially this year. So 2025 year-to-date with data for end of September, on absolute basis, it has almost had 28%. Really nice. And we still, because emerging markets have been having a very nice run, and we managed to have an outperformance, and that also, even if you look at it on an absolute basis, that's actually quite nice. Yeah, so everything I've been talking to you today has been explaining a bit about our strategy on long term, looking at our model, finding that super stock with those super characteristics that all comes together in a very diversified portfolio construction, very transparent portfolio construction, so that it can lead to the nice track record and nice result that we saw in the last two slides. So it's enhanced indexing equities. It does deliver long-term value. We've seen it with the Curate funds since 2020. And thank you all for being here today. And Oderilja, thank you very much.
Thank you, Leda. Robeco manages two mandates for Curate. The first, the Curate Global Sustainable Equity Fund, invests in a broad and diversified portfolio of shares listed on the global stock markets. The objective of this fund is to enhance client returns relative to the broader global equity market by using data signals to improve stock selection. The second, the Curate Global Emerging Markets Equity Fund, follows the same approach. However, instead of focusing on developed markets, it targets outperformance relative to emerging economies, including China, India, and Brazil. The fund provides investors with access to a portfolio of listed companies in these high-growth regions, offering the potential for greater diversification through exposure to sectors and industries often underrepresented in developed market indices. But you'll hear more about these two mandates, along with the rest of Curate's global equity range, from our next speaker. Ali Simpkins will take us through the art of simplifying global investment choice, showcasing how Curate Investment makes world-class investment talent accessible to you.
Good day, and thank you for joining us today. It's my pleasure to introduce you to Curate Investments, and more specifically to the exceptional asset managers we've sought out from around the world to look after your clients' money. We've all experienced the explosion of choice in our daily lives. From streaming services to coffee orders, having options is seen as a good thing, but too many options can quickly become overwhelming. This challenge is magnified when it comes to investing globally. Did you know there are approximately 143,858 unit trusts globally? To put that into context, if you had 1 year to research all of them, you'd need to look at 394 funds per day. That's clearly not realistic, and your time is better spent with your clients, not buried in fund fact sheets. And that's where Curate comes in. We built Curate Investments on a belief that more isn't better, but better is better. Our manager selection process is designed to cut through the noise and focus on what really matters. Through global partnerships, we access exceptional teams who share our values and can deliver consistently for our clients. We don't just assess performance, we go beyond that. We assess the thinking behind the numbers, seeking managers with a clearly articulated investment philosophy. They need to demonstrate why they are unique in their approach and show that their processes are repeatable and risk-aware. We endeavor to meet the teams, test their conviction, and evaluate their risk management processes. Once selected, we build long-term partnerships with them, continually monitoring their performance, behavior, and alignment with client expectations. And of course, if things fundamentally change, we act, always in the best interest of our clients. During the session, we hope to demonstrate this selection process and take you on a journey around the world to meet our managers and share why we believe they stand out in a sea of options. Let's begin in Rotterdam, where we meet Jan de Koring from Robeco, one of Europe's largest quantitative asset managers.
My name is Jan de Koning. I'm a portfolio manager from Robeco and I live in the Netherlands. Robeco was founded 95 years ago, and one of our first directors said every investment decision should be research-driven. And it's still a key philosophy that we apply as of today for managing our quantitative portfolios.
The question we get asked often is, why quantitative investing? In essence, quantitative investing leverages data and algorithms to construct portfolios designed to deliver repeatable and consistent outcomes. The key to success in this form of investing, however, is deep research and continued innovation. That is why we partnered with Robeco to manage our quantitative portfolios, because as Jan explained in the video, every investment decision at Robeco is research-driven. And over 20 years ago, Robeco pioneered quantitative investing and have continued to lead by building portfolios driven by evidence and data signals. In terms of the Curate's quantitative fund range with Robeco, they manage our enhanced index funds. This is a form of quantitative investing. It is similar to passive investing in that it invests in an index. However, based on the data and algorithms, the approach goes one step further. Robeco actively over- or underweight stocks relative to the index using refined models that combine value, momentum, quality, sustainability, and even analyst signals into the approach. Now, you may be among the investors who value the benefits of passive investing, and rightfully so. Passive investing offers broad-based exposure, transparent benchmarks, and of course, lower costs. But how does it stack up compared to enhanced indexing? You still get those benefits, but when you deliberately over- and underweight relative to the index, it also results in smarter stock selection, stronger return potential, and improved sustainability. But the proof is in the pudding. Robeco managed 2 strategies for Curate investments, each with track records that have recently surpassed 5 years. The first is an enhanced indexing fund that aims to outperform developed markets. The graph illustrates the performance of the Curate Global Sustainable Equity Fund. It shows the peer group quartiles within the bar chart. The dark blue representing first quartile peer relative performance, and the light blue representing second quartile performance, etc. The yellow line tracks the performance of the Curate Global Sustainable Equity Fund, which has consistently delivered performance ranked within the first quartile of the peer group. Similarly, the mandate that aims to outperform emerging markets exposed to countries like China, Brazil, and India has performed in the top quartile relative to its peers. Another advantage of investing within the Curate Global Emerging Markets Equity Fund is that it is exposed to sectors including technology, consumer defensive, and energy, which are underrepresented on the JSE. The JSE obviously having a higher exposure to resources. Typically, South African portfolios are underweight emerging markets. And in fact, this year, emerging markets outperformed developed markets. And it's something that we should not continue to ignore, especially with the current geopolitical issues. Robeco has been all about the numbers and the signals, but now let's travel to Boston in the USA to talk about the BFNs. What does BFN mean? Well, simply put, we're talking about big flippin' numbers. Here are some stats. The generative AI market was worth $29 billion in 2022. Today, it's around $50 billion. That's a 55% increase in just 3 years. ChatGPT, for example, now attracts over 5 billion visits per week and has surpassed 1 billion users. The Magnificent Seven have committed $400 billion towards AI development, which is the equivalent of South Africa's GDP. And those numbers just reference tech, but there are other massive opportunities that are out there and still need to be uncovered in sectors such as healthcare, fintech, and e-commerce. Growth is happening, and it's happening fast. So we searched for a manager that is built to capture this kind of inflection, and we found Jennison Associates. Let's hear from Mark Baraboo, the portfolio manager of the Curate Global Growth Equity Fund, to learn more.
Hello, I'm Mark Baraboo from Jennison Associates, Managing Director and Head of Global Equity. We run a global growth fund for Curate. It's a very exciting product, we think. We like to target really innovative and disruptive businesses around the world for investing. These are game-changing companies. Using innovation, they bring huge advantages to consumers, whether it's meeting unmet need in the marketplace or delivering very exciting new products and services to their customers. It can also be companies that are targeting other businesses with big productivity enhancing applications, maybe developing the next generation of technology that we'll all utilize someday.
So essentially, what is the secret sauce within Jennison? Well, they have dedicated analysts to hunt for the next structural winners. That means not the player that will come second, only the companies that will be the best within their industry. These companies are obviously difficult to find, and there aren't many. Think of the Magnificent Seven. But over the last 15 years, Jennison have caught the development of the internet, mobile internet, cloud-based computing, and of course, generative AI. They also give you access to other sectors that we wouldn't get in South Africa, including healthcare, fintech, and e-commerce. So why have they done so? Well, because they don't hire analysts with the quote, value mentality. And once they have uncovered the next growth company, they will implement with high conviction, holding only 35 to 45 shares in the portfolio. They hold companies like Nvidia, Microsoft, Amazon, Netflix, Hermes, Ferrari, and Mercado Libre, a large online retailer in Brazil. All these companies offer something unique and lead to an undeniable consumer demand and competitive advantage. These are the kind of stocks that clients love to talk about owning. The beauty of this growth portfolio is that it will always be invested in companies on the cutting edge, companies of today and tomorrow, not of yesterday. But conviction cuts both ways, and having a strong sell discipline contributes significantly to performance. Jennison do not subscribe to a buy and hold approach, and one such example is Tesla. Tesla was a strong performer for the fund, but by mid-2023, rising EV competition, particularly from China, and unexpected price cuts to maintain market share signaled a shift. With oversupply outpacing demand and weakening fundamentals, the team decided to exit the position entirely, concluding that Tesla is no longer ranked among the top 35 global growth stocks to hold. As per the line chart, not holding Tesla contributed to returns within the portfolio, similarly to holding the share pre the sell decision. Despite Tesla being a big contributor towards the portfolio, every single position has to earn its position in the portfolio every day. And that also illustrates that they do not fall in love with the stock, regardless of its contribution. Now, let's jet off to the English countryside to meet James Noodler from Evenlode Investments, manager of the Curate Global Quality Equity Fund.
I'm James Noodler, and I'm a portfolio manager with Evenlode Investment. I look for investments which are long duration and have, well, actually infinite duration, ideally, and which can generate attractive returns ahead of inflation for a very, very long period, where you don't have to worry about reinvestment risk, roll risk, anything like that, which can grow as an index on the broader world economy and ideally go a bit ahead of that. So that confines me, well, pushes me towards listed equities, which I think have got the longest durability out there among financial instruments. And then within equities, listed equities, it makes me concentrate on ones which have some sort of hard to replicate competitive advantage. It can be household names like a Colgate or a Diageo, or it would be companies with more esoteric reasons for existence like an Experian or a Verisk or an Informa. But those sorts of companies I have found through my career compelling as investments with a degree of valuation sensitivity built in as well. The single investment principle on which I would never compromise is the quality of the instrument. So it has to be an equity with durable pricing power, and that pricing power comes from that competitive advantage we talked about.
To summarize, Evenlode looks for high-quality businesses at sensible valuations and ensures there is a robust risk management process to ensure long-term compounding returns for shareholders. The majority of South African clients invested offshore have a significant exposure to quality already, given the focus on some of the larger management brands in South Africa. This is a great opportunity to truly provide a differentiated offering to your clients that will work well alongside your current managers. Let's unpack this approach with an example that we can all associate with quality. We all know what quality chocolate tastes like, and we sure all recognize this brand. In terms of quality, Lindt has exceptional brand equity. And as you will recall, in terms of what you paid for those gold bunnies this past Easter, they certainly have pricing power. And although the consumer may be under strain, Lindt has historically shown that a roughly 10% price increase has typically resulted in only about a 3% volume decline, still yielding around 7% growth. Also, they demonstrate the diligence to reinvest their capital. For example, they continue to invest in marketing during the pandemic, unlike their peers. A distinguishing feature of this manager is their valuation overlay, which sets them apart from their competitors. Evenlode were assessing Lindt since 2020 and used the increase in cocoa prices as an entry point into the quality company in April 2024. Never overpaying for quality companies with strong moats. Lindt is still held in the portfolio today, offering a great shareholder return resulting from 150 million Lindt bunnies sold per year. And essentially, if you were to line them up, that would be a line of Lindt bunnies from Switzerland, where they're made, all the way to Cape Town. Next up, we head to New York, to the manager of the Curate Global Value Equity Fund, focusing on only buying the cheapest 20% of the market. Yes, you heard correctly, only the cheapest 20%. Now, I'm sure you must be thinking, junk, value trap, cheap for a reason. But Lyrical have a different take. They search for the gems amid the junk. Why do they think that they can find these gems? Well, as per the chart, over the long term, the cheapest stocks have consistently delivered strong returns. Since 1974, investing in the lowest priced quintile of the MSCI World Stocks, you would have outperformed by over 5.5% annually, in spite of the fundamentals. So when you do consider the fundamentals, Lyrical Asset Management have proven that deep value investing, or buying at the steepest discounts, does generate long-term alpha. Let's hear more from the founder and CIO, Andrew Wellington.
I'm Andrew Wellington. I'm the founder and chief investment officer of Lyrical Asset Management, and I live in New York. There's a lot of different ways to invest in the stock market. At Lyrical, we're value investors. You can think of us as we're the bargain hunters of the stock market. Some investors like to chase the latest trends or the hot new thing. We sift through the market and look for those stocks that have been ignored or been missed. And as a result, we can get really good businesses at really cheap prices. And value investing is a lot about what price you pay. You could take a great business. You could take the best business in the world. But if you overpay for it, you're gonna get a bad return. All of our investments have three specific traits. We summarize this with VQA. Those three traits are value, V, quality, Q, and analyzability, A.
Let's unpack their VQA investment discipline. Essentially, they're looking for stocks that are cheap, good, and simple. As we saw on the previous chart, there are high-quality businesses within the bargain bin. To avoid the pitfalls of value investing, businesses must be easy to value and simple to understand. Lyrical don't invest in companies like banks, which have unpredictable earnings. Think about the large FX trading desks of the international banks. And furthermore, they also avoid asset-intensive businesses like airlines. This results in an uncommon combination of deep value and growth. The Curate Global Value Equity Fund has a lower price-to-earnings ratio, yet because of their VQA approach, they uncover stocks with earnings higher than the MSCI World and MSCI World Value indices. Let's apply the Lyrical way in an example. On this slide, we show the long-term share price, earnings, and PE history of Ameriprise compared to the MSCI World Index. Let's look at the price. The stock was cheap in early 2011 when Lyrical entered the position and had a PE of 13 times relative to the 20 times earnings of the index. In terms of quality, it delivers an earnings growth rate of 3.5 times that of the index. And lastly, analyzability. Ameriprise is a financial advice business which has over 2 million clients in the US, and their cash flows are easy to understand and forecast. Trading at lower PE multiples with superior earnings meant that this gem contributed meaningfully to the portfolio. A great example of the VQA principle, and this can be applied to each of the stocks they hold. Bringing it all together, each of these active managers follows a distinctive investment style: value, quality, and growth. These styles perform differently through different market cycles, but what matters most is that our managers stay true to their core belief system. And when you look at their portfolios, there's remarkably little overlap, highlighting just how differentiated they are. For example, there is no surprise that our selected growth manager and our selected value manager have no stocks in common. There is only one stock overlapping the quality and value portfolio and 4 overlapping the quality and growth, given the strong competitive advantages of these companies. In conclusion, here is a summary of the Curate range of global equity funds available on the Momentum Wealth International platform. We believe these funds opens a world of opportunities for you and your clients. We created these funds based on how you, as financial advisors, construct your clients' portfolios. Whether you're seeking low-cost passive alternative strategies, high-conviction growth, deep value opportunities, quality compounders, or if the blend is your friend, our carefully selected managers combine the science and art of investing, each guided by a philosophy worth backing. And we've brought them to you, to South Africa, so you don't have to search the world of funds alone. For more information, please contact your investment consultant or your Curate fund specialist. Thank you for your time. We look forward to the journey ahead.
Thank you, Ali. That wraps up our Curate Exhibiting Our Investment Artist webinar. We know how valuable your time is, and I would like to thank you for joining us today. We hope you found this webinar insightful. Please complete our event survey, as your feedback will help us shape this event going forward. Until next time, goodbye.